Hey guys, welcome back to another video with Alden and myself. We had the opportunity to go to an event recently. I spoke and on life insurance, and Alden, you came along for the ride, and I bring you because we had really smart people at this event. But there was two people that we met, and when we were talking to them, they're like, "We love insurance. We have a strategy," and we're like stoked. We're like, "I love that." But then they opened up their mouth and they shared what they actually have, and you were able to blow their freaking mind. And so I won't give much away other than millions of dollars of difference, and we can go into that. So without further ado, Alden, I'll pass it on to you.
Those of you who know my story, I came into this insurance industry because I wanted an IBC banking policy, and I went to an advisor and I'm like, "Hey, I want this." They're like, "Oh, absolutely, we can do that for you. Here we go." Got it, bought it, paid premium, did a lot of research after the fact, which I learned my lesson now, and discovered that I had purchased a variable universal life contract with a very high surrender charge and no access to cash value in the first couple of years. I became so pissed off, to be honest with you, at a lot of the half-truths that were told during the process that I became an insurance agent to fix my own policy, and I liked it so much that I started doing it full-time. So this type of thing, unfortunately, happens in the insurance industry far more often. Now, I'm not going to be anybody, or I'm never going to say that anybody's doing it intentionally to mislead. I am sure that there are people out there that do, and that's just the unfortunate nature of living in a fallen world. But I'm going to give the benefit of the doubt to the people who created this policy. And when we dive into the numbers, you're going to see very, very quickly what kind of insurance product this is, why it was built the way that it was. And I'm going to try to highlight for you the key differences and benefits of just building the exact same contract in a different way.
I love it. Let's dive in, bro.
So diving into the numbers here. So this is a policy that was actually purchased, or it's already in force earlier this year. We've got $20,000 of annual premium going in for 4 years. You can see that highlighted on the left-hand side. 4 years of 20, and then they drop funding to $8,000 per year moving forward.
Yeah.
The far right-hand side, we're going to have the death benefit from the non-guaranteed section, and let's just address that elephant in the room for the moment. Guaranteed values, as we know, this is an assumption that this insurance company is never going to pay a dividend again. This particular company that we're looking at here has had over a century and a quarter of paying dividends every single year, so the likelihood of that is very small, but that's where the guaranteed numbers come from. Non-guaranteed are taking a projection of their current dividend and moving that forward on a time scale, attributing that dividend to the policy. So for discussion's sake, this particular client had some more trust in the non-guaranteed numbers. That's not always the case, but most of the time it is. So the first thing I noticed when I look at this policy is the amount of cash value they have in year one. Now, to really understand why an insurance policy needs to be structured a certain way to help somebody achieve the goal, you have to understand what their goal is. This particular person, their entire business model is leveraging cash, either from a private line of credit against properties, etc., to then do additional investing. So they were sold on this concept of being an asset to put money into a policy to then leverage it back out. So their stated goal, day one, was maximum cash value to maximize leverageability. I want you to keep that in mind. They put in $20,000 for 4 years in a row, and they have $70,000 to show for it. The nice thing about this design, however, is that they do get to a point where they break even within the first 10 years. Amazing. So it's not your typical run-of-the-mill whole life insurance. It is optimized for cash value, but the numbers were not adding up for me. What I did is I actually looked at where the premium dollars were going. So when we look at the premium dollars, we're buying a whole life insurance, $633,000 for $8,000 a year. The additional amount going into the policy is $12,000. So that's totaling the 20. If you do some quick math, this is a classic 40-60 design. But the key difference in most of the modern insurance policies that you're going to see that are 40-60 designs is that there's no term insurance. So what does that mean? What it means is every dollar in this policy to the benefit of the policy will ultimately go toward building cash value. The problem is a huge portion of it disappears very quickly because, as we know, with whole life insurance premiums, base premiums, they don't generate cash value very quickly at all. They do long term and they're very efficient at it. But very early on, a lot of cost against the policy, which is why we have such a low initial cash value. The plan was to fund for 4 years, $20,000, and then drop funding to 40%, $8,000 a year. Out of curiosity, I wanted to see at what point this policy crossed $1 million of cash value based on the projections from the insurance company on their dividend. Caleb, if you would write down the age 76 for me.
Will do.
Okay. So 76 years, and at that time, we've put in $384,000. So just for kicks, giggles, and ultimately to save this guy a whole lot of money and heartache, I built this policy. A lot
Well,
of
and
numbers on the
just a
screen.
couple questions.
Go ahead.
Couple questions I have, Alden. So
Yeah.
initially, full first 4 years, 20 grand. Did he want to spend more than 20 grand ongoing, or did he like that cash flow?
So this is the policy that he was advised to do. Fund it for 4 years, stop funding it. And actually with this policy, you don't have the option to fund it any longer with the paid up additions rider, the way it was underwritten, from what I can tell.
That's what I'm saying. Is
Yeah.
one of the biggest problems I see with this is like you're literally designing a policy that the more efficient it gets, the less you can put in. Did this person? Because I know a strategy here. I'm not saying the agent did this on purpose, but it's like you do this for the first couple of years, you drop just to the base, and then you start a new policy, so you get a new commission kind of deal. And I know that some people teach that. Mike. So number one, did this person want to continue to put $20,000 in, or like what was their? I know like you didn't have a ton of time to talk to them. You just maybe did you just take their cash flow and make it identical from a standpoint of like we're just going to take your exact plan and see how we could make it like what would it look like if it was just going into a policy that was differently designed, or did you have a conversation about, hey,
hmm
what if you had the ability to put more after year 4?
So both. I think the first thing that I'll mention, this is absolutely a sales strategy. One of the things you will hear from some people on YouTube is that we want to get a policy to the point of capitalization. Right? That's the term that they often use. Capitalization, depending upon who you talk to, means 15 different things. But what they're talking about in this sales strategy is, hey, at one point, can I stop putting in PUA, still put in $1 of base premium, and get more than $1 of cash value? So for discussion's sake, you put in 8,000, your cash value in 1 year goes from 70 to 80. So you put in $1 of base premium, and now you got more than $1 of cash value. There's a lot of people that would say, look how efficient this is. Now every time I put $1 in, you get more. But we lose all aspect of flexibility. You can't put in more premium. And so it's not a flexible or grow with you type policy. It's definitely one of those ones where, hey, after 4 years, you want another policy, come back and buy another one. So it's not the type of design that we would build, because it's not efficient. It limits your possibilities. And what they wanted ultimately was the ability to just get capital in here to start lending. They didn't even know it was possible to fund longer. They didn't understand
Yep.
that I could have flexibility in the premium.
Got it. Okay, let's
Okay,
share the next. I just wanted to mention those two things.
perfect. So what I showed him is this idea of, okay, the money's gone, you can't get it back. You paid your first year premium. What we can do is roll your surrender value into a newly structured design. So what we can see here is now he's a year older, right? Because policy was placed earlier this year. This policy wouldn't probably get approved until early next year. And we're rolling over the excess cash value and then also adding $20,000 of premium. So his outlay hasn't changed. We're going to roll over his cash value from the other policy. That's $12,401. And then he's going to do his planned premium of $20,000. All right. Now, a couple things I want to point out very, very quickly here before we do this side-by-side comparison that'll probably make somebody cry. When we're looking at this policy, the biggest difference is the structure of the premium, where those dollars are going. The first policy, 40% were buying whole life insurance, 60% was buying paid up additions for 4 years. With this policy, if you look down here, we're putting $2,000 toward base cost of insurance, $1,300 toward term insurance that gets the death benefit higher so that we can then shove in an additional amount of capital into paid up additions. So your total premium per year is identical to the other policy, but the difference is where those dollars are going. And that makes a huge, huge difference from a cash value perspective and death benefit perspective. And on top of that, enhances your flexibility. If for some reason in some year you can't come up with $8,000, well, instead of saying, oh, darn, surrender the policy or have to borrow against your cash value to pay your premium, you can come up with this, $3,300. That'll keep the policy in force. Huge amount of flexibility, and you can go all the way back up to 20,000. So I want to make that very, very obvious, and that's why we need to work with people who understand this as actually possible. I don't know the agent who wrote this policy. I know their name, never met them before. I don't know if this is a sales tactic, something they believe in, or something else. So benefit of the doubt completely, but there's a better way to do this. So okay, I'll pause there, then I'll show this side by side.
Yeah, no, I 100% agree with you. I think we're showing cash flow to cash flow. When I say the cash flow to cash flow, like nothing changes out of pocket with their assumption. But I want to just point out we're literally making it more flexible, which is so I think all cases better to have more flexibility. More options are better than less options. But I would say, just to be very clear, this is not what this client is necessarily going to jump into. We just want to we're using this as an example. Whatever this person ends up doing is their decision. And what we could easily do is maybe create an ability to put more money in the future. But when Alden was showing me this, I was like, we need to share this with YouTube, because I just find that people find this interesting, number one. And number two, there might be people that should bring us what they currently have for us to analyze it. Like, we are here to analyze what you have, and there were people that at that same event that they showed us what they have, and we're like, "You are in amazing hands. Like, you're doing great." Is it the most optimally designed policy? Maybe not. But, like, we're not here to try to, like, it's frowned upon big time to do, transferring policies. It has to be, like, clear and obvious, like in
Yeah,
football. It has to be clear and obvious to change the decision, and you can say for yourself how clear and obvious this is. So without further ado, let's jump into it.
all right, here we go. So this is what we have on the left versus what could be if we did an exchange, pulling, like I said, cash value from left to the right side of the table. You'll notice that premiums at 20,000 stop after year 3. Remember, that's because we're a year ahead in the policy on the right. So first thing I want to do is let's just look at year 2 cash value. All right, so we've got 28,000 and some change on the new policy. Over here, 30,000. Okay, no one's winning any awards. This isn't a better policy so far. Let's go out to the end of the 5th year. 80,000, left-hand side. Right-hand side over here, we're pretty much equal. Okay, so it took 5 years to overcome the cost of doing a 1035. This is one of the big reasons why this doesn't make sense for everybody. If you have a well-funded policy and you've had it for a long time, 1035s may not make sense unless your goals completely change.
Yeah,
Now,
and hold on,
that,
I also want to point out the death benefit is lower in a policy that you're showing than the initial death benefit,
that's
at
right,
least early on. So
initially,
I want to
yep,
acknowledge that, and again, this person that we talked to could care less about the death benefit. I'm not saying that's right or wrong. I'm saying all they wanted to do in this strategy was cash efficiency. But I do want to acknowledge, like, whenever you're looking at should you transfer or not, you have to factor in those things as well. And sometimes, um, getting term insurance placed on that is great as well. So just want to acknowledge that.
absolutely. All right, so year 5, we've kind of cut up in cash value. The death benefit is still lagging a little bit by about $80,000 or $60,000. Now what happens? Same premium outlay, but all of a sudden these cash value numbers on the right-hand side start to really take off. So I'm going to go down. Let's just go to age 50. He's been paying this policy for 16 years, age 50 on the left-hand side. So over that period of time, we've got a fairly big difference, right? We've got $40,000 of difference in cash value. The death benefit on the right-hand side policy as well, the new option, is also higher, okay? If this policy continued to be funded for a long period of time, let's just look at what this is actually doing out to life expectancy. The last year that we could compare was age 75, because the policy on the left was a pay to age 75, basically. So we're going to highlight that entire column. Go down here, same numbers you can see, $8,000 a year up until this point. This is last year we can truly compare. Caleb, what is that number from the cash value perspective on the right-hand policy?
I can't even tell. Is it 1.5?
0.5 million. When you compare these two, from age 75, we're at $1.5 million in projected cash value. We've got a 2.1, almost $2.2 million death benefit. What do we have on the other option? Well, we haven't broken $1 million yet. We're just shy of that. Remember, the number I had you write down was age 76. And then we're over $600,000 short on the death benefit. Think of this.
Wow.
Think of
Wow.
this like shooting a rifle. All right. You're aiming a rifle at a target that's 1,000 yards away. If you make one slight adjustment, you're going to be many, many feet, if not yards, off of that target because of the distance involved. This is why getting it right the first time from a cash value benefit perspective and the policy trajectory is so, so important. This policy is still going to grow cash value. The one on the left, it'll grow cash value. It'll have permanent death benefit. There is nothing wrong with that. What is wrong with it is for the goal of the client to maximize cash value performance, to give him the option to leverage against the policy to increase his portfolio and his business, it's not the most efficient vehicle to make that happen. And over the course of time, we have over $1 million of difference in cash value if you continue to walk this policy out. So,
Oh yeah. If you zoom out, and then a big difference when it comes to long-term death benefit, the point that I want to just highlight is this person's gonna fund. They believes in insurance, like they want insurance, and they're gonna buy more insurance. And so, what would be interesting is if you look out, and I know we don't have this today, but what if this person bought every 4 years a new insurance policy? And, like, you actually look out over the next 30, 40, 50 years, that versus, setting up insurance from the very beginning, Alden, it's multiple millions. It's 3, 4, $5 million difference probably on the cash value and death benefit side, which is just crazy to me. And that's, like, why on one hand, I'm, like, a fan of insurance, and another hand, I'm right there with, those people that are like, "Don't buy insurance from any random person." Because it's, like, stuff like this, like, the person was saying all the right things, and we're $500,000 off, and less flexible, and less death benefit, a lot less death benefit long term. That's rough, and it's
yeah.
unfortunate.
And the thing that with this particular product on the left-hand side, as I understand it, we can't put in more premium in paid up additions after the 5th year. So you'd have to start a brand new policy. The policy on the right, you can go up to that $20,000 mark if you wanted to past year 4. The only thing that's going to limit that is how many times you can do that before we have to limit our funding to prevent a MEC. And so this whole comparison is to show what could have been based on the funding numbers, the plan, right?
Yeah.
Now, this conversation may go many times beyond this, and he ultimately may decide, you know what, I want to be able to have even more flexibility, or I want a higher base and higher term to have more death benefit, less cash value, but that's okay because that's what I want. This is just an example of you saying, I want cash value accumulation best possible that we could get, and getting something that's very, very different.
Yep, I'm with you. I love
Awesome.
this. I believe you have another example as well
I
that's
do.
even different. Do you
So
have any final words to share here?
no final words. I think the numbers kind of speak for themselves. And big disclaimer, these are projections, right? Mutual insurance companies project their dividends, but we're also at a historically low dividend and interest rate environment. So I feel like we could trust the dividends and the projections pretty well.
Does this person care about guarantees? What were the guarantee columns like long term?
Yeah, guaranteed on the right-hand side is still better long term. This is going to be a different policy design. This individual actually does care about the guarantees a lot more than not guarantees. We've had a conversation. He understands the time horizon of these companies paying dividends, how long they've done it, the projections, the financial strength of the carrier, all these different things. But to him, knowing his bottom line is really important. That's how he runs his business. That's how he wants to run his policy. So the non-guaranteed column, I think, is going to wow a lot of you, but it didn't wow him necessarily. What did wow him is getting more flexibility and more cash value. So this policy is built, it's the same agent, different individual, same type of design, same limitations as we discussed before. $40,000 going toward base premium, an extra $60,000 in the first 4 years, really driving cash value. Now for this particular person, he wanted to see apples to apples. The what if I went back in time and just bought a different policy. So this isn't showing a 1035, this is showing the what if, okay? All right, so highlighted columns right here. Same $100,000 for 4 years. Dropping it to 40 moving forward. The death benefit has a slight decrease. So we went from about 2.5 million to 2.3. But that's about where the similarities stop. When we look at the first year cash value, left-hand side of the page here, 61,000, right-hand side, 82,000. Okay, immediately $20,000 difference. That's a pretty good difference. Let's go out to the end of the $100,000 a year funding. So right-hand side, 385,868. Left-hand side, 352,258. All right, we're starting to pull ahead to a larger degree, about $33,000 of cash value difference. I'm going to run this out just to make time easier. Go out to age 60,
Yeah, 1.6 million.
1.6 million to $2 million in comparison.
Wow.
The death benefit,
And
3.9 to 4.7.
yeah, wow. And the other thing that I want to just point out is his original contribution, his minimum contribution is going to be 40,000, and the contract that you showed him was less than 20 at like minimum. So it's easy. There's like more flexibility across the board, which is also, if it doesn't matter to you, it should matter to you. That's the thing I'll say is because
Absolutely.
it's flexibility. We don't know what the future holds, and so having more flexibility is better than having less flexibility.
Yeah, and one of the things I've said many times on this channel is planning doesn't exist in a vacuum. And so no plan that you're going to put in force today is going to look identical 40 years from now. Life happens, premium amounts change, insurance company profitability, dividends change, your loan, your usage, all these things change. But we can't do planning of what we're going to expect in the future without making some assumptions. And so the assumptions that we're making here is that his premium doesn't change for basically 36 years. After 36 years, just look at the comparison and the difference in the legacy and the cash value it's created. Right-hand side, this is the new policy. This is what could have been $5.3 million of cash value and $7.5 million of death benefit. We haven't even broken $4 million of cash value, and we're still on the fives for death benefit on the left. So this,
Wow.
again, whole life
Yeah.
insurance will bid cash value. It's a byproduct of the vehicle itself. But one thing that I don't think anybody, if they truly understand how dynamic life and business can be, is going to complain about is having the ability to, oh my gosh, I have to come out of pocket 40 grand this year to keep my policy in force or alive. Maybe I'll just do
Yep.
19 instead.
Yep.
Huge degree of flexibility, and we can put in
Yep.
additional premium into the policy on the right-hand side, the no option.
Agreed. Yeah, lots of thoughts. I even when we talked about this person, where we kind of came to the conclusion that they shouldn't be maybe putting in the type of premium into that policy that maybe they were originally pitched. And then it's always interesting. It's like you'd think when you talk to someone who's a fan of properly structured life insurance, like us, like we're a fan. But I personally look through the lens of risk management, and I never, ever, ever, ever want to create a safe asset and make your financial situation less safe. And I think that's one of the big problems I see in a lot of people's financial situations is the safest asset that they have is creating a lot more pressure to their financial situation because they're over leveraged. And I don't say over leveraged because they're using leverage like other people's money. I'm saying that they're committing too much to something, and so to their plan, and it's creating a lot of pressure there. And so I want to just create like a friendly reminder of it's okay to start somewhere. It's not the end of the world if you have to start another policy in the future. In fact, most people will, but let's not intentionally design a policy to drop off all the PUAs after 40 years and not give yourself that flexibility. And so that's the thing. We wanna give people the benefit of the doubt. When I first got into space, this is what I was taught. This is the design that I was taught. So I'm very empathetic to this type of deal, but the moment that I knew better, I didn't touch this with the 10-foot pole. So it's like, so we'll give all agents, the benefit of the doubt, but, um I don't understand why someone would design something like this if they knew what we knew. I'll just say that. All right, Alden, is there anything else that you want to say as we land the plane here?
I think the numbers speak for themselves. You know, given all the assumptions, given the goals coming into the conversation, this is what could have been. And this gentleman is considering a 1035B because of it, right? Because the goals were not met by his previous agent. And so Whether we end up doing that, doing something else, adjusting his premium, all those remain to be seen. We wanted to bring this to the table for you to understand, as a viewer of our channel, that there are a lot of ways to build an insurance policy, and that's why it's so important, and our preference is that you work with us, because we have the ability to create the flexibility and the returns that we're seeing on the screen right now.
Yep. Two types of people are watching this. You're either someone who has an insurance policy or shopping for an insurance policy. If you already have an insurance policy and you want us to take a look at it, we'd be more than happy to do that. You can reach out to us. There'll be a link down below. If you are an agent or an advisor that is watching our content and feels like you could be doing a better job, or you have not been taught what you don't know what we know when it comes to insurance, there will also be a link for you to have a conversation. We want to do whatever we can to best help you. We don't currently have an agency today, but the more people we hear from, we're open to helping in any possible way. We have an event once a year for people in this space, and we will do whatever we can to best serve you. So if you see a link for advisors, please click that if you are one. And we want, again, to be as helpful as possible. And so in advance, thank you. And Alden, thank you for all that you do, and just being my wing person when it comes to even this event. It was wonderful, and I look
Yeah,
forward to doing more events with you.
absolutely. Kel, I want to say one other thing. I'm not out here to attack this particular company, this particular agent. I think I've said that a couple different times. But something I do want to put on the table is I reserve the right to not know everything. Now, what I see in this product, what I hear from the client about their conversations with the other agent, makes me believe that this product was sold incorrectly. However, if I'm missing something, if you're an advisor and I'm missing something obvious here that I'm just not seeing, please let us know. Put it in the comments, reach out to me over email, and we'll make a correction. But this is what we see. This is what we heard from the client. This is ultimately the plan that we wanted to propose to him as a juxtaposition. And it kind of knocked his socks off. So look forward
Yeah,
to hearing from you guys.
and I'll take it one step further. If you disagree with what we're saying, let's have you on and let's talk about it, and let's look at real numbers and talk about all. I mean, we understand illustrations are not 100%, and so let's have a conversation about pros and cons. But again, I want to just hear people actually stand by an illustration like what we're comparing to, and that would be super interesting stuff. So please be willing, if you're open, let us know in the comments, and we'll get you on the show. So Alden, thank you.
Hey everybody, Alden here. I wanted to point out something that I did not get a chance to point out on the channel because I actually didn't see this. This is something that the client brought up to me in a conversation over email. So check this out. Top policy, the top illustration that you're seeing up there, this is a illustration that we were looking at before. It's got, at the end of 70 years, projected cash value with the current dividend performance of this company of $768,000 and about $1.3 million of death benefit right there on the top. Looking down, this is the illustration that I proposed to this individual. This illustration is showing a midpoint of the current dividend, meaning we're going to cut that dividend that's currently being paid in half and check out what the cash value is. So right there at age 70, all the way across. And remember, guys, this is the exact same funding strategy as far as the dollars into the policy. The only difference is how that policy is structured and what companies it's with. This is huge. If we cut the dividend of this other company exactly in half, it still almost beats the first policy. It's only short by about $20,000 after 37 years. This is phenomenal. It's absolutely outrageous that this is even possible. But this is the importance of having a design that's on your side from day one, giving you all the flexibility in the world that we can, giving you the best upside potential, and giving you a great company to work with, where we have even the midpoint is outperforming the competition. Right now, look at the far right-hand side, that non-guaranteed current dividend performance, $1.12 million and a $1.8 million death benefit. So I thought this would be beneficial for you guys to see. Take a look. This just blows my mind. And the gentleman who sent this over to me was very, very shocked and also very pleased with the new design that we put together.